Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro technicals, and crystal ball gazing in that order. Today is Wednesday, December 11th, 2024. Today's episode, the CPI year over year, came out as the market had already been expecting at 2.7% for the regular, and the core minus volatile food and energy coming out at 3.3. Notably, this was the last month expected and actual. The notable market reaction was really in the Fed funds futures. Now, the December meeting being in a week from now, going from 92% apparently yesterday. I thought it was lower than that. I mean, a week ago it was only 80%, and before that it was even lower. We got to a point actually where we are at 50% for a little bit, if you remember. But now 98% chance of a cut. And now the chance of there being no cut is actually zero. We're actually pricing in a small possibility of double cut actually for December. Only a 2% chance right now. So although even the core inflation rate is 3.3% and the Fed target is 2%, the market is interpreting right now this, that's sort of looking inflationary, but it's not like trending upwards. It didn't surprise markets to the upside. And there were certainly some markets sort of expecting that a little bit, and we didn't get that. However, the 10-year break-even inflation rate apparently was pricing in a little bit lower inflation readings here because we popped, from day to day, 0.01% higher, but still higher. And we're back into this. Before, it looked like we had broken down below this sideways pattern that we've been going on since the beginning of October, actually. And now, we're going back into this sideways motion, basically the market agreeing or disagreeing enough to the point where the 10-year break-even inflation rate is priced to expect a average inflation rate of 2.3% over the next 10 years as it stands right now. This typically drops when it's more clear that we're going into a recession or something worse. But yeah, there's an argument here, so we're kind of like agreeing at that point right now. Notably, this isn't 3% as the CPI came out, and so this market is clearly agreeing that it's going to be lower than that moving forward over the next 10 years for the moment again. Notably, we also have PPI coming out Thursday, along with the initial jobless claims, which could shake things up any which way. The daily reminders remain the same. Watch Monday's show, 12/9/24, with a brassy clock to hear me walk through these items. Also, the crystal ball readings are the same, and I haven't really changed my allocations of my portfolio, which I also walk through on Mondays. Diving straight into the charts, the S&P 500, the SPX went up by 0.82%. So this rolling over, it seems like the CPI data was enough to get the market excited enough that there's not going to be no cut basically in December. There being still a higher chance of there being no cut, I think, made the S&P 500, I'm going to call it, have a sugar low. And then, so now we got a little sugar high. That's what I'm seeing here. And I don't know if it's going to go up or down. No idea. All I know is it's extremely overvalued and it would make sense to roll over to the downside. Longer treasury yields went up today, sending TLT to the downside. I want to note that it still looks like we might be back in a now wider megaphone type of pattern here. I'm really curious where we'll go from here. No idea. But it's still my favorite place to be because of the valuation differences between the return on bonds and the, potential returns on stocks right now. There's a big mismatch. So, it goes up, it goes down. I don't care. For me, I'm going to hold this until they turn the money printer back on, which they're inevitably going to have to do. I found it interesting that while TLT dropped today, we also had the MOVE index drop significantly, actually to a new low over the most of the recent past. We haven't been this low in the MOVE index since May of 2024. So not expecting volatility in bonds yet. TLT itself dropping by an entire percent today. Interesting little mismatch. My guess is that it's the dumb money, the retailers that are tapping out of treasury bonds, and it's smart money loading up on it. I would think that is what is going on, since I'm probably not the only person seeing what I see. Obviously, the MOVE index involves more institutional money, smarter investors basically than the fund TLT itself. But I really don't know. I find it very, very notable that the Treasury yield curve, with the rates on the very long end of the curve rising today a bit, we now, is this the current Fed funds target? It's between 4.5 and 4.75. So in this, you can't really see it in this blue zone, and we're in there, and it's at 4.55, while the 20-year is at 4.55 as well. So it's actually completely flat across the curve. We're headed into the more accommodative mode for the market. Very interesting. We haven't had accommodative Fed monetary policy now for, it must be over 3 years. Let me check. So taking a look at the Fed, just the federal funds rate, we started hiking, it looks like, mid 2022. So yeah, that's almost, what is that, like 2.5 years now? We haven't been in this accommodative environment. We've been in a restrictive mode, or going into restricting mode, at least for 2.5 years. And we're finally coming out of it. The Fed funds it's dropping. And, if we zoom out on this, you can see every time we start dropping on the Fed funds rates, that's when the recession happens. There it is in 1990. The gray bar is, of course, the recession. If you know how these charts works, in 2000, it tips over, recession, financial crisis. So accommodative is when it's low, and then restricting, choking the economy. It gets to a height, it pauses, it turns around, and we go into a recession. Every time. Look at this, 1956, rise, dropping in the recession. Rise, we pause, we drop, recession in 1960. Rise, 66, 67, I guess there was not an official recession there, although if they're lowering the rates, obviously they're worried about something. And then, rising, dropping during the recession. When this drops, it's usually during, a recession. And it's cleaner the further out you get. The closer you get to the modern day era. But yeah, we're there. We're headed straight into the storm. It could not be clearer. It's clear as day for me. But, remember, I'm just a guy with a crystal ball. Last chart of the day, oil breaking above this wedge pattern. And so I guess some professionals I'm hearing are looking to short around the $74 range because of another trend line that goes from further back. But as it stands, oil looks very short-term bullish. I was thinking it looked like, because we're bumping along this line, I'm assuming you've watched Monday's show. If maybe not, this is the line back to 2021, bump 1, 2, 3, 4, 5. And then recently, 6, 7, 8, 9, 10, we just keep bumping. So I was thinking with this wedge and this just bang on this line here, we'd be breaking down, and this would be it. But that's not happening. So the oil market is going to be prolonged higher for a little bit longer here. it looks like, at least on a daily basis. I don't think this is going to last. I think we're headed into a very cheap oil situation very soon, within the next like 2 or 3 months, I'd say at this point. But that's just me and my crystal ball, and that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.